If you've been thinking about starting your investment journey, 2025 is the perfect time to dive in. In today's video, I'm going to guide you through the basics of investing, including why you should start now, how to pick a brokerage, what to invest in, how to approach investing, and what you might expect. Let's get started. Hey everyone, Doug here. The first question we have to answer is why should you invest at all? Why not just stick all of your money into a savings account somewhere, forget about it, and have that be your little nest egg? Well, there's a couple reasons. And the first one is the earlier you start investing, the more time your money has to grow in the market. Thanks to the magic of compound interest, you've also probably heard of this called the snowball effect or something similar, but small amounts invested early on can grow into something really significant over time. In addition, the world of investing has never been more accessible. There are so many platforms out there offering zero commission trades, fractional share investing. You can start with as little as $5 and work your way up and start building the good habits now that'll pay you, pardon the pun, but dividends later on down the road. If you stick around to the end of the video, we're also going to go over some examples of how these small initial contributions end up snowballing into something really significant given enough time invested in the market. So stay tuned and let's move on to the next subject. Picking a brokerage. Let's get this out of the way right off the top. There are a ton of brokerages that you can actually choose from, and they're all relatively good. They all do about the same thing. There are differences, but if you're a beginner investor, I don't think those differences are really going to matter to you as far as the feature set goes, right? What I would say is that, companies like M1, companies like Robinhood and Webull, those are the newer players to the market. They typically have a more streamlined onboarding experience for new users or new investors, whereas companies like Vanguard, Charles Schwab, E-Trade, and Fidelity, those are all kind of the older players in the market. They're very well established. But like I said, you can go with any of these. They're all going to do everything you need them to do when you're a beginner investor. One thing I will say is that you may already be using one of these platforms if you have a 401k through your work. So it is entirely possible that you already have an account with one of these companies, in which case it might be easier to just open up an individual brokerage or something along those lines with the company that you already have an account with, because they already have all of your information, right? Do a little bit of research, pick one. Like I said, M1 Finance, Robinhood, Webull, they tend to have a little bit better of an onboarding experience for new users simply because they're newer applications, but you can use any of them. So what do you actually invest in? After you have your brokerage account set up and you have the entire market at your disposal, what do you actually put your money into? It's a really big question and it's a really big answer. I'll start with saying there are a ton of options as far as what you can put your money into in the market, and it's going to be overwhelming when you first start. I'm going to try to simplify it to the best of my ability, but I will say that you should try to do your own research, try to get familiar with some of the different investment strategies that exist out there and, make your own decision. But let's start with talking about individual holdings. You can think of these as individual companies that you want to invest into. So it could be something like Apple or Microsoft or Tesla or AT&T or Johnson & Johnson or whatever company, right? And you might be passionate about one of their products or one of their services, and you think that company is going to continue to grow over the next 10, 20, so on years, right? I generally steer new investors away from this. I will say that trying to pick out individual stocks is statistically very unlikely to work out for you in the long run. Even experienced traders fail at this constantly. What you should probably do is look into an ETF or an exchange traded fund that tracks either the S&P 500 or the total US stock market. An ETF, you can think of it as a fund that you can put money into, and that fund invests across the entirety of the United States or across the entirety of the S&P 500. It depends on the fund. right? And we'll go over a couple in today's video just to give you something to kind of start out with. But what this does is it automatically diversifies your investment because you're investing across the entirety of a market instead of individual companies. The other benefit here is that ETFs or index funds that track the entirety of the market generally outperform individual holdings anyways. So not only are you getting the diversification, you're also getting the biggest return on investment, generally speaking, by investing into these ETFs. So it's kind of a win-win when you think about it. Most of these ETFs also pay some form of dividend to you, generally on a quarterly basis, sometimes on an annual basis, but you'll get some kind of kickback from it as well, just from owning a small portion of all these different companies. Moving on, we'll talk about real estate or REITs just very briefly here. But a REIT is a real estate investment trust. And what this does is it gives you access to real estate investing through the market as opposed to going out and purchasing property and worrying about a mortgage and renters and all of these different things, right? So it's an option that exists out there. These are still generally individual holdings. There are ETFs that are focused around real estate as well. But generally, for a beginner investor, I'd probably shy away from these, and I'd really look at the ETFs that track the entire US index or the S&P 500. So coming back to ETFs very briefly, I want to direct your eyes to the VTI stock total return chart on the right side of this slide here. And what this is it's looking at the last 20 years of the index fund VTI. And you can see that over the last 20 years, it's gone up 616.91%. So that's the return on investment if you had started investing in this index fund 20 years ago. So you can see that this is the power of being invested in the market in a long time. Like I said, this is an index fund that tracks the entirety of the US market. So you're diversified the whole time. You're less prone to risk because of that diversification as well. So this is why, generally speaking, newer investors and even experienced investors, ETFs, index funds that track the US market or the S&P 500 is really the way to go. So now that we know what we might invest in, we should talk about how to invest, what strategies that we employ as investors to put our money into the market and see returns come back to us, right? And there's a couple different ways. The way that I generally do it and the way that I generally recommend other people to do it is to dollar cost average into the market, into the positions that you've chosen. This is commonly abbreviated as DCA. But what this basically means is you're investing a fixed amount on a regular basis, regardless of what the market is doing. So if VTI, for example, if it's down, if it's up, I don't care. I'm just investing the same amount of money every week, every month, whatever your cadence is. And I'm buying on the lows, I'm buying on the highs, I'm buying when it's, averaged out. And like I mentioned, being able to automate this is crucial for me. For example, like I use M1 Finance, and they give you the ability, and I'm sure most brokerages do, they give you the ability to just deposit money directly from your bank account into your brokerage on whatever cadence you want. So I use this as a way to dollar cost average into all of my positions in the Dividend portfolio on a weekly cadence. So every single week I'm investing money, and it's just investing on the highs and the lows. It's just doing it automatically in the background, and I don't even have to think about it. I never even see the money. I don't miss it. It works really, really well. The other great part about this is that it takes all the emotion out of it. So week in, week out, I'm investing and I'm not emotionally invested. The last part that we should talk about, and we've covered this a little bit when we talked about ETFs and index funds, is diversification. You want to ensure that you're well diversified across multiple sectors of the market. This is why index funds and ETFs are so good for investors. So I wanted to give you an example of what investing on a long time horizon actually looks like with data, right? So I found this calculator online. It's from smartasset.com. They're not affiliated in any way with the video or channel, but it's just what I found online. So in this example, we have said that we're going to invest $100. That's our starting amount of capital. In addition, we're going to contribute $500 a month to this portfolio, and we're going to do that for 30 years. And we expect a 10% rate of return annually. And this is actually the rate of return of VTI over the last 20 years. You could be more conservative. You could say, hey, I'm actually going to go 8%, right? Because I expect some fluctuations or whatever, right? But the rate of return as of now, 10%. So that's what I'm putting in here. And you can see over 30 years that our investment actually grows to over $1 million. And it breaks it down even. So over those 30 years, we've contributed $180,000 to the portfolio, but our compounding interest, and this is the magic of investing, has generated $952,000 just by itself, just from us contributing on a regular cadence into good index funds. If we look down here, we can even get a better picture. So let's say 2030, the amount of interest that our portfolio earns is just shy of $5,500. If we peek ahead 10 years, well, suddenly we're making just shy of $25,000. And again, we can peek ahead another 10 years. Now it's $77,000. You peek ahead again, 2053, it's over $100,000 a year in just interest that we're earning from our assets appreciating and paying out dividends and all of these other things that are associated with investing into the market. So this is kind of the proof behind the earlier you start, the better return you're generally going to get. You have a longer horizon of investing, right? Your money can sit in the market and compound longer than someone who might need to pull it out for retirement, for example. Now, that being said, it's generally never too late to start investing. If you're 20, if you're 30, if you're 40, even if you're 50, right? You're still getting a lot of time in the market, and generally you'll be making more. So, the calculations change a little bit. If we take this and we say, well, we only are going to have like 20 years to grow. You've contributed $120,000 of your money, but your portfolio still generated $260,000 by itself. And I'd rather have that $260 than not have it, right? So this is the power of compounding interest. The longer you can leave your money in, the better off you're going to be. So that being said, I hope this was helpful. If you did find it helpful, please leave a like and subscribe to the channel if you want to see more, and leave a comment for me down below as well. Was it helpful? Is there stuff I didn't answer? Is there stuff that I need to follow up on? I'm happy to do a follow-up video if necessary, but I just wanted to put this out there. That's going to do it for me. I hope it was helpful, and we'll see you in the next one. Bye-bye.